Investing isn't just about markets, charts, or numbers. It's about psychology, and many investors underperform the very investments that they own. Why? Because of emotions. Fear, greed, impatience, overconfidence all show up at exactly the wrong time. And if you don't have a system to manage your emotions, your long-term performance will suffer. My name is Quinton Chambers. I'm a chartered investment manager, financial planner, and wealth advisor. And over the last decade, I've helped families and business owners navigate the markets, their psychology and money, and ultimately how to make better financial decisions. And in this video, I'm going to show you how behavioral biases impact investment decisions. Now you can stay disciplined, focused, and successful over the long term. Now ask yourself, have you ever chased a hot stock or fund, sat in cash waiting for the perfect time to invest, or even felt nervous during a market downturn, thought about changing your entire investment strategy, or worst of all, actually sold during a market crash? Now, you're not alone. But it's so important to remember that if you don't understand how to navigate these emotions, you're exposing yourself to future risk. Emotional investing is one of the biggest reasons investors, whether it's DIY or working with an advisor, underperform the very investments that they're invested in. According to the data, this happens across all strata of wealth, from the blue collar to the ultra wealthy. Anyone can sabotage their portfolios with reactionary decisions. So here's a real world example, and one that I come across regularly. I was at a networking event and I was chatting with someone about their recent investment experience. Let's call this person Mark. Now, Mark is 47 and he's a senior engineering manager, and he's been investing for the last 20 years. And yet, during every major market swing over the last few, his emotions have got the best of him. In 2020, he panic sold during COVID's market crash and then missed the subsequent rebound. In 2021, he wanted to make a comeback and bought high growth tech stocks at their peak. Now, given what Mark does professionally, clearly he's an intelligent guy. And because of this, he thought he can time the market better than most. However, with the benefit of hindsight, his performance clearly said otherwise. Now, sorry for picking on you, Mark, but he's not alone. A well-known DALBAR study shows that over the last 20 years, investors on average return 3 to 4%, whereas the market returned closer to 8%. And there's other studies that show that missing just the best 10 trading days over the last decade can cut your returns by almost 40%. And when we're talking about this idea of volatility or market swings, both the most positive and negative days tend to cluster together. Now, this highlights the importance of sticking through a long-term plan, especially amongst bouts of volatility, as you don't want to run the risk of missing the best days in the market. I often say, when you go through these days, it's not a negative thing, it's actually feedback because you get to understand what your true risk appetite is. Okay, so with that, I'm going to share my 4-step system for how I help clients build a behavioral investing system to help protect them from themselves. Loss aversion is going to be a big one. People feel losses twice as strongly as they feel gains, which leads to the tendency of fear-based selling. Then we have recency bias. Investors have the tendency to expect recent events to repeat themselves. So whether that's a market crash to continue crashing or a rally to continue rallying. So the next one is going to be very popular because of things like social media, which lead to meme stocks or crypto pump and dumps, and that's herd mentality. And that's the thought that because everyone else is buying in, you should too. Then we have just plain overconfidence, and that's just believing that you can do something that others can't, which is very unlikely, especially in the world of investing, where you have some of the smartest minds in the world. Now, awareness is a first step. These instincts are human, but they are not helpful when it comes down to investing. Step 2 is to build a discipline-based investment strategy. The key elements to a discipline-based investment strategy are diversify your portfolio across different companies, sectors, regions, and asset classes. This helps cushion volatility and keeps you invested. Automate your contributions. This comes back to paying yourself first and having a cash flow allocation plan. This means deciding which amount is going to savings, how much, and over what period of time. A perfect dovetail from automation is using dollar cost averaging. That just means you're investing your money on a periodic basis, whether it's biweekly or monthly, so that you get the average price in the market over that period of time. Write down your plan. So many investors get this wrong. And it's so important to write down what your actual strategy is to make sure you have conviction and commitment to this strategy over a certain period of time and make regular revisions as time goes on. Strategically rebalance instead of reacting. When markets are down, it could be an opportunity to tax loss harvest and sell off your losing positions. And on the other side, when markets rise, take profits. This becomes discipline when you have specific parameters for when you take profits or when you take losses, whether it's a 5 or 10% buffer, and that allows you to make sure that you're doing this in a systematic way. So that way you're not reacting to markets, and in fact, you're actually being proactive. Step 3 is going to be implement guardrails for market swings. When markets crash is not the time to sell off a large portion of your portfolio. Instead, you want to strategically rebalance to minimize further loss. And when you're faced with what looks like a big rally, that is not the time to aggressively buy in. It's the time to stick to your plan. You don't know if that's the start of a rally or if you're near the end of a rally. And that's why it's always best to be measured. And then we have step 4, and that's just using an advisor to keep you accountable. One of the most underrated values of working with a good advisor is not just portfolio construction. It's actually behavioral coaching and having a trusted relationship that they can communicate with you effectively during heightened emotional moments like market crashes. This can mean helping you avoid panic selling during downturns, bringing objectivity to moments of fear, greed, or excitement, and then ultimately making sure that your investment strategy is aligned with your financial plan and they both stay on track. Personally, I would never tell a client one of the reasons they pay me is to help them manage their emotions, but when it comes down to an emotionally charged topic like money, one of the best things that I can do for someone is helping them have a clear, systematic plan that's written that helps you from being your own worst enemy. Now, despite what the news may tell you, you don't need to be a market genius to be a successful investor. But you do need to stay invested, diversified, and disciplined, especially when your emotions are telling you to do the opposite. Now, I hope I've made it clear. Behavioral investing mistakes can be avoidable. And with a clear plan and the right guidance, you can protect yourself from making these mistakes and keeping yourself on track towards your goals over the long run. If you struggle with emotional investing, or you just want to make sure you have a more structured plan over the long term, feel free to reach out. I help Canadians across the country build investment portfolios that stay aligned with their goals while managing their emotions. Thanks for watching. Hit the like and subscribe for more smart money tips. Till the next one, be well.